Now, he calls it a wolf market. And last time he was on the program, that was just before the end of the year, he said stocks were going to move higher in January. You know, indeed, in a mid-August report, he said that investors should go ahead and buy stocks. So far, so good. So what's next? My guest is Michael Purves. He is the chief market strategist at BGC Financial. Michael, a pleasure. So far, so good. You've got the call right. Do you think that stocks are going to continue their ascent?
Yeah, I do. If you've looked at it, you know, the tenor of the market has changed a lot. We had some disappointing news you just referenced with retail sales and the jobs numbers, and yet the market's kind of shrugged it off. You know, 3 or 4 months ago, or certainly in the depths of the, you know, the huge volatility we had in September and October, you wouldn't have had that. You didn't get the benefit of the doubt. The markets have a bullish tone right now, and so I am absolutely bullish on this. But I want to also stress I'm tactically bullish, and I think if
Is this where the wolf comes in?
Exactly.
I mean, because you call this a wolf market. It's not a bear market. It's not a bull market. It's a wolf market. What does that mean?
It means long-term trends, bull trends or bear trends, do not get sustained, and so you have to. As an investor, you also have to recognize this and grab your returns when they present themselves. So right now, I'm bullish, but you know, if we get up to 1360, which is where I think we'll get over the next few weeks, you might want to really think, you know, about taking some decisive profits at those levels if and when we get there.
Well, you say you know, grab the returns while you get them. I mean, the Nasdaq, for example, I was talking about Microsoft today, was up 1%. The Nasdaq was up 4.6%, 4.5% so far this year. That's pretty good. Why not take a little bit of the money off the table?
Well, certainly you can do that. You know, that's very prudent to do. You know, to go in that and harvest carefully.
Prudence, is that a watchword for 2012? I mean, do investors really believe in prudence, or do they tell you that, but really they just want more?
Well, I think if you go back to 2011, where you know you had some very strong rallies for the first several months of the year, and it certainly felt like a bull market. If you were smart or lucky enough to take profits at those peaks, and then perhaps get short on the back half of the year, from August through October, you did brilliantly. It wasn't obviously an easy trade to do, but you have to recognize that what was driving the wolf market in 2010 and 11 is going to probably, those factors continue into this coming year, 2012.
I'm glad you mentioned August, because in mid-August, I believe it was August 10th, you came out with a report and you said, go ahead, buy stocks. What were you looking at specifically then that gave you that signal?
Well, there was 2 factors. First was relative valuation. When the dividend yield on the S&P 500 was below the 10-year treasuries, that to me was a very strong signal. Of course, you look at stocks, you know, a lot of key stocks, you know, very high quality companies trading at less than 10 times earnings. Those are very, very cheap valuations. The one thing that would have produced a big further downturn in the market after that precipitous drop, with the VIX spiking to 47, 48, would have been an absolute systemic collapse of Europe, right? Not stagflation, not euro jitters.
But it didn't happen.
But it didn't happen, and ultimately, my judgment was the market had been factoring in a higher probability than what was really likely to happen, given how the events of Europe were going to play out. You have to remember that just breaking up the euro doesn't just happen with a flick of a switch. That's a time-consuming process as well. So, to my mind, the odds were on your side that the market was going to start consolidating. It was a messy, sort of sloppy and noisy consolidation, but it did consolidate and base at those levels. And my main message was that if you had been aggressively shorting the market to start taking off some of those hedges, particularly when the VIX at those extremely elevated levels.
So you think the S&P 500, I mean, we're a couple points away from 1,300. You think that keeps going higher? What's
I think right now, you know, it's a cliche, but the trend is your friend right now. And I think, you know, we're going to see obviously some profit taking here. But, you know, if you look at the, you know, the Euro news continues to be generally favorable. The U.S. news is better than awful.
Well, as you said, people shrugging off the initial jobless claims report today, 399,000, and also the retail sales, 0.1%. Everyone was looking for 0.3%. People ignore it.
Exactly. An enormous amount of capital went into government bonds, and that is a big reservoir of support into U.S. equities. And you look around the global equity markets, and those are a little less obvious right now.
All right.